Yes guys, so welcome back. So we will continue our discussion on Ind AS 36 and this will be the last session, I promise, a discussion of Ind AS 36. So we had too much of elaborate discussion going into Ind AS 36. We discussed about every concept which is included in Ind AS 36. Apart from that, we also discussed about the illustrations and also the workbook problems. Now, towards the end, when we started your additions in study material, I included a new concept called as impairment of goodwill associated with non-controlling interest, where I discussed about what is non-controlling interest, what are the ways of measuring non-controlling interest, where there are two ways. One is measuring non-controlling interest at fair value and the other one is at proportionate cost method. Now, in both the aspects, there was a significant difference in the amount of goodwill which is recognized and how is the goodwill being impaired. We have seen two illustrations or two examples regarding that, and that should have given you some holistic understanding of what is this concept of impairment of goodwill allocated to NCI. Clear? Now, moving away from this concept, which we have just discussed, are certain other questions which are included in your additions to study material. So your additions to study material have two more questions to be solved. So let's start with them and then subsequently move into our concept of compendium of solved illustrations, where we will ignore certain questions which are already appeared either as a part of our workbook or a part of our illustrations, but all other questions we will try to solve. Clear? So let's complete this Ind AS 36 at fast. So let us make sure that you people have a better understanding of the standard while we move through the additions to study material and compendium of solved illustration. Let's start. This is compendium, guys. Yeah, this is the illustration. This is the additions to study material. Look at the question number 88. Entity A acquires entity B for 50 million, of which 35 million is the fair value of identifiable assets and liabilities which are assumed. The acquisition of B Limited is to be integrated into two entities of A Limited CGU, with the net assets being allocated as follows. So what are the net assets being allocated? The fair value of the net assets allocated to the CGU1 is 25 million, CGU2 is 10 million, and the total being 35 million. Now, if I look at what is the actual purchase price, 35 million. Sorry, 50 million. What is the fair value of net identifiable assets? 35 million. So therefore, the difference between the purchase consideration and the net assets transferred, that is 15 million, should be accounted for as goodwill. However, what I am talking about is only the acquired tangible and intangible assets allocated to the CGU of A Limited as 25 and 10, the total is 35. 15 million of goodwill allocation he did not give you. Read through the question, we will understand if there is anything which is said regarding the allocation of goodwill. In addition to the net assets that are assigned to CGU2, the acquiring entity expects CGU2 to benefit from the synergies related to the acquisition. So CGU2 is expected to realize higher sales of this product because of the access to the acquired entity's distribution channel. There is no synergistic goodwill allocated to other CGUs. So the entire goodwill should be only allocated to CGU2. Entity A allocated the purchase consideration of the acquired business for CGU1 and CGU2 as 33 million and 17 million respectively. Determine the allocation of goodwill to each CGU. Read through the question once again. There is a purchase consideration of 50 million and there are net assets acquired to the extent of 35 million. He's talking about allocation of goodwill. So I would expect you people to answer the question. First of all, please read through the question once again. Please read through the question once again. Start solving this. This is module 4. Read through the question. I'll give you some time. Read through the question, then I will start solving. Yes, guys. So let's get back to the question and see what he said. He's clearly saying that the 50 million of purchase consideration which was transferred to the other entity can be allocated to CGU1 and CGU2 as 33 million and 17 million. That makes it a total of 50 million. But the fair value of net assets allocated to CGU1 and CGU2 in total of 35 million is also given to you. So comparing the net assets and the purchase consideration, we should be able to identify or determine the amount of goodwill arising on business combination which can be allocated to each of the CGU. So let us write down. Determination and allocation of goodwill arising on business combination. Let's start. First, I'll have three columns out here. One is your column for total. The other column is for CGU1, first CGU, and the other column is for CGU2. Please remember, all rupees are in millions because the question itself is quoted in millions. Okay. So let's start then. The first figure that I will start with is the amount of purchase consideration. Your purchase consideration in total is 50 million. But this 50 million is also allocated to CGU. CGU1 had a purchase consideration of 33 million. CGU2 had a purchase consideration of 17 million. To this, like you have understood yesterday as per IND AS 103, we need to add NCI, non-controlling interest, in entity B. Guys, he said he acquired B Limited. So he did not say he acquired only 80% of B Limited, 40% of B Limited, nothing he said. Therefore, I can definitely say that there is no NCI at all. So that means the total is 50, 33, 70. Now this 50, 33 and 17 should be compared with fair value of net identifiable assets in B. My fair value of net identifiable assets in B are 35 million. How are these divided? This 35 million, if you go back to the question, he is saying it is divided as 25 and 10. Based on these numbers, I can determine what is the resultant goodwill. 15 is the resultant goodwill in total. 8 allocated to CGU1 and 7 allocated to CGU2. Goodwill on business combination. is 15, 8 and 7. 15 in total, 8 allocable to CGU1 and 7 allocable to CGU2. Read through the answer given in the question. Absolutely right. You got the same answer. We put a total column at the beginning. We put a total column at the end. Other than that, there's no significant difference. Look at question number 89 then. 1st January, year 1, entity Q purchased a machine costing 2,40,000 with an estimated useful life of 20 years and a 0 residual value. Guys, residual value is 0. That means the entire 2,40,000 is depreciable value of the asset. Their useful life is 20 years. That means per annum depreciation is 2,000. Per annum depreciation is 2,000. Depreciation is computed on a straight line basis. That is what we said, 2,000 rupees per annum. The asset has been revalued on 1st January of year 3, 2 years after you have acquired the asset. Now the revalued amount is 2,50,000. Guys, if you depreciated the asset for 2 years up to the beginning of year 3, your depreciation is 2,000 rupees per month per annum. So for 2 years, the amount of depreciation is 4,000. So 4,000 rupees of depreciation from 2,40,000 would have given me 2,36,000 as your written down value. This 2,36,000 rupees of written down value is being revalued upwards to 2,50,000. That means it would have given me a revaluation surplus of 14,000. However, there is no change in the estimated useful life on that date. So therefore, 14,000 would have been transferred to revaluation surplus. The asset would have been increased to 2,50,000. Now this 2,50,000 should be depreciated over 18 years. Why 18? Because 2 years have already passed by. So the remaining useful life is only 18 years. On 1st Jan, year 4, an impairment review showed that the machine's recoverable amount is to be 1 lakh and its estimated useful life is only 10 years. Significant change, guys. Significant change occurred because the impairment review you're doing, your recoverable value is only 1 lakh and your estimated useful life is only 10 years. This happened at the beginning of year 4. That means 1 year after your your upward revaluation of asset. What is he asking you? What is the carrying value of the machine on 31st December of year 2? The revaluation surplus arising on 1st January of year 3. Carrying value of the machine on 31st December of year 3. Immediately before impairment. Impairment recognized on 31st December of year 4 and its treatment thereon. Guys, 31st December of year 4 is 1 year after the impairment is over. Okay, impairment loss recognized in the year to the 31st December to year 4. Look at the question above. On 1st January year 4 itself, the impairment review showed. So that means you are impairing the asset at the beginning of year 4. He is asking you what is the amount to be recognized at the end of the year and therefore also what is the treatment thereon. So you have to identify what is the remaining carrying value of the asset as well. What is the depreciation charge in the year on 31st December of year 4? And during the course of utilization of the machine, the company did not opt to transfer a part of the revaluation surplus to your retained earnings. So that means he is not transferring a part of revaluation surplus to retained earnings. This concept we have seen under depreciation as IND AS 16. We said whenever the asset is revalued upwards, then utilization of revaluation surplus, we said the excess depreciation charged on the value of the asset should be transferred from your revaluation surplus to retained earnings. So he did not do that. So therefore revaluation surplus is intact, existing out there. I would want you to read through the question and tell me how to start solving the answer. Read through the question and tell me how to start solving the answer. If you already identified it, please start moving. Please start moving, start solving. Start solving. Module 4, question number 89. I'll give you another minute of time. Please make sure that you keep solving. I hope we are clear. Shall I start solving then? So let's go. First, year 1, Jan. On the day, the cost of acquisition of the asset I acquired the asset, and the asset was acquired at 2,40,000. This asset had an estimated residual value of 0. Therefore, the entire amount should be considered as depreciable value of asset. This depreciable value of the asset should be depreciated over their estimated useful life, which was 20 years. Or what is the depreciation parameter? Write down the numbers. Residual value 0, depreciable amount 2,40,000, 20 years. Sorry guys, did I say 2,000 rupees of depreciation? No, it is 1,200 rupees of depreciation. What? Yep, this is 12,000 rupees of depreciation per annum, not 2,000, 12,000. Now that you know that the asset will be depreciated at 12,000 rupees per annum, the first effect happened at the beginning of year 3. The first effect happened at the beginning of year 3 when there was a upward revaluation. So let's see. On that day, what is the carrying value of the asset? For me to determine carrying value of the asset, I will apply the computation. 2,40,000 is the original cost. I am depreciating it by 12,000 every year. Like this, I depreciate it for 2 years. That means the total amount of depreciation charged on the asset is 24,000. From 2,40,000, therefore, the amount is only 2,16,000. On this day, they have revalued the asset upward. On this day, that is in beginning of year 3, that is in Jan of year 3, they have revalued the asset upward. Revalued amount. My asset was revalued to 2,50,000 upward. Therefore, it resulted in a revaluation surplus. Is not even using it for depreciation, guys. Revaluation surplus is 34,000. Based on this, once it is revalued, you have a change in the depreciation per annum. My depreciation per annum, calculate 2,50,000 cost of the asset, depreciable value 0, whole divided by 18 years, that is the remaining useful life. 2,50,000 divided by 18, not perfectly divisible. The amount would have been 13,889. Guys, remember, Your earlier depreciation was 12. Today's depreciation after upward revaluation is 13,889. The increase in the depreciation per annum is 1,889. If you remember utilization of revaluation surplus, the amount of increase in the depreciation of the asset should be transferred from revaluation surplus to OCI, where it forms part of retained earnings. But unfortunately, he's saying that the enterprise did not use this technique, so the revaluation surplus is not touched. He kept on depreciating 13,889. Nothing transferred from revaluation surplus to retained earnings or to the OCI. Clear? Now go to year 4 Jan. Year 4 Jan, what was the carrying value of the asset? Year 3 Jan, I have revalued. Year 4 Jan, what is the carrying value after revaluation and after 1 year? It was revalued to 2,50,000, of which I charged a depreciation of 13,889. Therefore, I'll be left out with 2,31,000, 2,36,111. 2,36,111 is the carrying value. At that particular point of time, when your carrying value was 2,36,111, he is comparing it with the recoverable amount and testing for impairment. This is where we applied IND AS 36. Until now, we applied IND AS 16. Now I am applying IND AS 36 by comparing it with the recoverable amount. And if you look back at the question, he said that the recoverable amount to me is 1 lakh. Check the question. Yes, the recoverable amount is 1 lakh at Jan of year 4, and the estimated remaining useful life is 10 years. Since your recoverable amount is less than carrying value, 1,36,111 should be charged as impairment. What is the treatment of this impairment? The impairment loss should have been transferred to P&L. But since the asset was upward revalued earlier, I will reduce the impairment from the revaluation surplus to the extent available. Balance I will transfer it to P&L. Treatment of impairment or recognition of impairment, if you want to write it like that. This 1,36,111 I will adjust it to revaluation surplus to the extent I have revaluation surplus. If I don't have revaluation surplus, then I will transfer it to P&L. If you remember, your revaluation surplus in year 2, if you go back and check, my revaluation surplus was how much? 34,000. This 34,000 I will utilize against writing off of impairment loss. Balance amount being transferred to P&L, 1,36,111 minus 34,000 of impairment, revaluation. This will give me 1,02,111. That is the amount to be transferred to P&L. On this day, there is a change in the depreciation because of a change in the carrying value. Also, there is a change in estimated remaining useful life. Estimated remaining useful life of the asset is 10. Since the estimated remaining useful life is 10, my depreciation per annum, revised depreciation per annum, calculate. After impairment, the carrying value of the asset is 1 lakh. Correct? Residual value is 0. Estimated useful life is 10. Therefore, the depreciation will be only 10,000 rupees per annum. On this basis, year 4 December, my carrying value would have been my carrying value of asset at the end of year 4. Carrying value at the beginning after impairment is 1 lakh, on which I am charging a depreciation of 10,000. Therefore, the net carrying value of the asset after your impairment and the depreciation for first year after impairment is 9,000. That's it. So we have combined the concepts in this question to the extent of revaluation, change in estimated useful life, and also the impairment on the value of the asset. Please make sure that you take down the answer perfectly. I've been writing it slow so that you can take down the answer. Please make sure that you are copying the answer or you are solving by yourself. I expect this question to be solved by yourself because there's no rocket science in this question. Similar type of questions we have already solved. Yes, revaluation surplus is 34. Impairment loss is 136,111. Correct. 34,000 transferred to revaluation surplus. 1,02,111 charged to P&L. Year 4 depreciation is 10,000. And finally, therefore, the carrying value of the asset should have been 90,000. We did not identify the carrying value at the end of year 4. I've done even that as well for you. So, entire questions being solved. So, that will bring us to the end of discussion on your additional problems or the additions in your study material which happened in the year 2021. So, this is a very comprehensive discussion that we had with respect to your additions in study material. There are not some crazy additions which happened except for that except for the discussion that we had regarding allocation of or impairment to the goodwill of NCI. So that was the only peculiar aspect. The rest of the concepts are quite simple and very, very straight. Now, with that we come to the end of module 4, that is your additions in study material. However, that is not the end of the standard because we will have to look at the questions which are supposed to be solved under compendium of solved illustrations, which is a combination of model test papers, revision test papers, past exam papers. I've included everything into one shot, and that is your compendium, and you solve compendium on your own with a very little support of mine. Then you are very confident to go ahead with the standard. It will give you so much of confidence when you solve a question by yourself. So make efforts to solve the compendium of solved illustrations by your own. Clear? So whenever I read through the question, once you remember it, how to solve it, you start going. If there is a mistake, there's nothing wrong. A cutting is always a place where you can learn. If there's no cutting, that means you're not learning. So please make sure that you make mistakes. Your mistakes are only accepted when you're practicing. You cannot make the same mistake in the exam hall. So if you're not making a mistake in the class or when you're actually practicing, then you will make a mistake in the exam hall. So please make sure that you remember it. You make sure that you have the understanding to solve the question by yourself. If there is a mistake, try to correct it. That's the best way of learning forward. And we'll start with your compendium of solved illustrations under IND AS 36.